what we like is actually changing the asset class from retail to self-storage. And, our typical construction project is 2 to 4 million. So we're adding a lot of, a lot of investment into this building by changing it from one asset class to another. And that's what we call heavy value add, to where you're actually, doing some heavy lifting, and we wind up with some pretty incredible margins. So,
are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hello, everyone. This is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Erik Hemingway of Nomad Capital. Today, we are going to explore self-storage investments with Erik. Erik has nearly 22 years of experience in all aspects of construction and self-storage industry. He has been part of over $100 million of commercial real estate transaction and $60 million in residential real estate since 2006. He has built his first self-storage from ground up in 2006, and since built a personal portfolio of 4 self-storage facilities using value-add strategies. Erik, welcome to Decoding Cashflow. How are you today?
Thank you, Ted. Yeah, I'm doing really well. Appreciate you having me on.
All right. Yeah, we're going to have a great show today. We'll explore all the things about the self-storage, whatever strategies you implement to buy already built, and how you build ground-up construction. How do you do ground-up construction for self-storages?
Perfect.
All right. So before we dive deep into, all the strategies and stuff, why don't you give our listeners a little bit background about yourself? How did you get started into this real estate business, and what's your main focus as of now?
Perfect. Yeah. So I got into construction in 1995. My wife and I had 2 kids, and it was I was working at a job where I wasn't making very much money. So just had a friend who was a general contractor, and he needed help, kind of cleaning out the jobs, digging ditches, started at the bottom. So it wasn't really a pay increase right away, but slowly worked into becoming a superintendent and eventually a project manager. And I did that with this guy for 6 or 7 years, and then went on my own in 2001, got my contractor's license and started Elm Builders. Elm Builders, like the tree, and it was because we had 3 kids at the time, Emma, Levi, and Maggie. So that was the acronym we came up with, those three kids. And kind of was doing the same kind of thing as I was for somebody else, just doing it for myself now. And so we were building spec homes, custom homes, and just kind of, did that for several years in the early 2000s. Then I kind of noticed that although I was making great money, like as soon as I finished a house and got paid, you had to go back to work to build the next house, because it was just kind of a repeat. There was nothing passive about it. It was, as soon as you stopped building houses, you stopped making money. So that led me to start evaluating what's a way. My wife and I had been managing residential properties for someone. We were managing 22 to 24 rentals, and so I saw that kind of side of things, and I knew I didn't really want to build a real residential portfolio. And so I got interested in commercial real estate, and that led to a piece of property that looked like it was going to be a great location for self-storage in the town where we lived. It was a piece of property that I drove by every day, and finally just reached out to the broker and put it under contract, and had to go through, it was all new for me, like rezoning from residential to commercial, and getting plans drawn for a commercial project, which was really difficult. The easiest part about it, ironically, is the hardest part about doing projects today was the financing. This was 2005 and 2006. And it was literally just walk into a bank that I'd used for spec homes and said, hey, I found this piece of property. I want to do a self-storage. It's going to take about 1.8 million to buy the land and do the project, I think. And they were, yeah, sounds great. No problem. Yeah. Literally a handshake, and there was some paperwork, of course, but way, way simpler than it is today. And,
Yeah.
and that's how we got into the self-storage business. So that's how I got into real estate, and a little background of how I got into self-storage.
Awesome. Yeah, back in those days, right before 2008, it was easy. I wouldn't say easy, but it was easier to get loans than
Easier
right
for
now.
sure. Yeah.
Yeah. Yeah, and in the current market situation, I know it's a lot of paperwork, a lot of scrutiny, each and every small things. So yeah, it's little tough getting
Yep.
right now.
Yep. It's definitely challenging. So
Yeah.
yeah. So that was how we got into storage and commercial real estate. And after doing that, I really wanted to focus on commercial real estate. So
Mhm.
fast forward a little bit to 2008, we had an opportunity to move our family to Costa Rica. I had a job offer there to build houses.
Mhm.
So we did that for a year and a half, lived in Costa Rica, and I ran a crew of 20 workers that nobody spoke English. So had to really get up to speed of Spanish really quick. And we did that for about a year and a half in Costa Rica. So
Mhm.
we've done some international construction as well.
Awesome. And I heard about, traveling around the world.
Yeah.
Tell us a listener about a little bit. That's pretty
Yeah,
interesting about it.
absolutely. Yeah.
Yeah.
So then 2008 happened. And so by 2009, the folks that were buying second homes in Costa Rica from the United States and Canada, well, all that was gone. None of that was happening anymore. So we had thankfully sold a couple of commercial buildings in Arizona where we were from. And so we had a little bit of cash, and my wife and I had talked about traveling internationally with our kids, and kind of set on the idea of living on a sailboat.
Mhm.
And so we had some money. We had no work in Costa Rica. We had already sold our home and everything we owned basically in Arizona. So we thought, well, maybe now's the time to think about this sailboat idea.
Mhm.
So yeah, so we found a boat in Greece. I flew over there to make sure we would fit because we were traveling with 5 kids, and not really knowing a lot about sailing. We're from Arizona, so we didn't have a lot of sailing experience. But our original plan was to buy the boat, move our family onto it, and we thought, well, let's give it 1 year and sail around a few Greek islands. And I think
Mhm.
we should be able to figure that out. And then we'll sell the boat and do the next thing, go back to the US or whatever. So that was the original idea. We didn't know it was going to grow into, well, we first started when we got on the boat and started sailing. We met a lot of other boaters that were like, you really need to go visit Turkey because it's a fantastic country and
Mhm.
great for boating. So we ended up in Turkey. There we found out we were going to have a baby, our sixth. So then it was a big, struggle to figure out how this was going to happen. I told my wife, I said, if you want to go back to the United States to have the baby, I totally get that. And she said, well, let's see if we can figure it out over here. So we found a midwife in Israel. So we ended up sailing around the coast of Turkey and then over to Cyprus and then down to Israel, and had our baby in Jerusalem. So he was born there, and then we had to wait for the passport and birth certificate
Mhm.
and all that. And then so that's the adventure just kept growing, right?
So
So yeah, go ahead.
yeah, so after you came back to US, right? Tell us about your first deal after you came back to US.
Yeah,
Or
so
was
we
it was
we
it in residential, or you
yeah,
jumped
it
into self-storage directly?
no, we had kind of, spent our money crossing the Mediterranean and crossing the Atlantic Ocean, and came up through the Caribbean and then came into North Carolina. Pretty much had spent our savings, so it was time to get back to work and just kind of go back to what I knew, construction. I went to some real estate meetups and met some people that were doing flips. And just, I mean, I guess that's the great thing about having a skill in construction is if you can use your hands and have some tools, you can always, I think you can find work anywhere in the world pretty much. So
Yeah.
met some people and just started getting back into the business, framing, doing some trim carpentry, replacing floors, whatever we could find. Eventually got enough cash to do our own fix and flip residential. Then when we graduated from that, it's really just baby steps, right? So when we
Yeah.
started doing fix and flips, then we started doing spec homes in about 2014 or 15. And after a couple of years of that, we thought, let's go back to the storage, self-storage. We still had the one in Arizona. We kept it all during our travels and starting over in North Carolina. And by now, the property we'd had for whatever 8 or 9 years, it was really starting to do well and generating some great cash flow. And it was very passive. We didn't have to do a lot to it. And so we thought, well, this is working. Like, let's do more of this. Right. So we started looking for something we could either build ground up again or convert. We really liked the idea of conversion. And so we found a building here in Wilmington that was our first conversion back into commercial real estate. That was 2016. So I guess from the first storage to the second was about a 10-year gap, but then things started happening pretty quickly after that. And now we're have about 12 facilities. And when we finish building out the last 2 we're working on, we'll have about 5,000 storage units. So it's been a busy few years.
Well, that's awesome. That's
Yeah.
awesome. Love your story. The first conversion that you did, how did you find that conversion, that particular property?
Yeah. So we had just decided like the week before, like we need to get back into self-storage. Like that would, that's something we really want to focus on. And my wife and I were at a brewery. There's a lot of breweries in Wilmington, and we were having a beer, and there was this building across the street. It was all dark and it was obviously abandoned, a big commercial building. And I said, that would be perfect for storage. It's right downtown. There was a loading dock. There's no windows. The walls are about 12 inches thick, brick. And so I called the broker the next day and we looked at it, and they said, yeah, it's been empty for 8 years. It's been for sale for 4 years and nobody wants it. So we have 2 prices here to demolish it, to tear it down and build something else, whatever you're going to build here. I said, well, I didn't tell the broker, but I'm like, we want it exactly like it is. It's perfect. It was a old printing factory. So there was a big area of warehouse where they had all the printing equipment, which had all been sold. So it was just a big empty room, and then about 8,000 square feet of offices that we would need to tear out. So it was pretty heavy on the demolition, but the bones of the building were really good. So that was our first project back into conversions. And yeah, it was great. We still own that one today, and it's a great property. There's a lot of options for us there. We can go up, we can go 3 stories there if we want to convert it to a bigger storage eventually, or it's just the growth is happening all around us downtown there. So it's really great to watch things kind of unfold over there.
And you're only focused in North Carolina or other
No,
states also?
So we did a few. So after I did that one, then I refinanced it a year later and took equity out and put that on the next one. And that was an existing building that somebody else had already converted to storage. So we bought that. That's also in Wilmington. And we just kept hitting the ceiling. When I say we, I'm partners with my son, Levi. And we just kept hitting the ceiling of what we could do with our capital. And the next deal was just always out of reach. It would take everything we had to get into the next one and everything we had to get into the next one. And we thought, well, let's explore this idea of syndication and bringing in investors that can help us with the heavy lift. And we're happy to give up some of the equity and the profits from this, because we think they're great performing assets. And so we're happy to share that with investors. They're happy to get into self-storage. It's just a win-win for everyone. Yeah. And that's one of my core values is that if real estate is done right, then nobody loses. Everybody wins in some way.
Yeah, that's very true.
We provide a solution for somebody that's got this building in their family that they, essentially don't even want. They're paying property tax on it. They don't need it, and so we're able to take it off their hands. Then we can employ all the people it takes to convert it. We get to put investors' capital to work. We get to pay our staff, our team to run these properties. So, I think just everybody wins the whole way through. So I love that about real estate in general. It's, I don't think there should be anybody that loses.
No, in the long run, yes, of course. The trajectory is towards the north, always
right.
up.
Yeah.
Yeah. And
Yeah. So
sometimes you get a hiccups now and then, like for example, right now when the interest rate goes up, a little bit up and down, but on the long run, it's always up,
right,
no matter
right. I
what.
mean,
Yeah,
it's definitely more challenging now with interest rates, and it just has changed how we look for deals and what we,
yeah,
what kind of risk we want to tolerate and all those kind of things. But
yeah.
I mean, that's another great thing that I like about real estate. And I've seen through several
Cycles.
cycles in the
Yeah.
business. Where I was building during the dot-com crash in the late 90s, and 9/11 and 2008, and COVID and all. It's always the same. There's
Yeah.
some outside pressure that changes the market. But the great thing about real estate is I feel like there's always a deal to be had, or there's always an opportunity. You just have to be willing to shift the way you think about it. It's not going to be the same as it was 3 years ago or 10 years
Yeah.
ago. It's just constantly evolving. And I think you have
Yeah.
to be willing to adapt and be
Exactly.
creative and say, well, the status quo isn't working anymore. So we have to kind of go into the
Yeah.
phone booth, reinvent ourselves, and come out with a better idea or a different approach, or something's got to change, and just look at it with a different perspective. And I think there's usually a solution to be had somewhere in there.
Yeah, 100% agree with you on that. All right. So when you look for a new self-storage for conversion, right? What are the things that you keep in mind? Like, okay, I need this kind of building in this location. Height of the building or the height of the ceiling should be XYZ. What are certain criterias?
Yeah.
Tell us about
So
that.
we typically start with square footage. Like, we like to
Mhm.
look for buildings that are a little bit larger, like 70,000 to 100,000 square feet.
Mhm.
And then we start looking at the demographics of the area. How much storage is already there? What's the income per capita? What is the town growing? Is it shrinking? Um, and these are all things that we just take into consideration. None of them are necessarily deal breakers, but it's just all kind of contributing to our decision making, right? So, what percentage of the population is renting? Um, the storage that is there, what kind of rental rates are they able to charge? How full are they? And then kind of work through that. And then, of course, with the building itself, we've done buildings that are fairly new, a newer grocery store. Some buildings are really old. We're working on one now that's 100 years old, but it's already been upgraded to sprinklers. Sprinklers is a huge thing for us. If it has sprinklers, that's a big cost savings. We typically underwrite that we're going to replace all of the air conditioning on the building anyway, just because we want to start with a fresh,
Mhm.
warranty, and we know where it's going to be a long-term hold for us. And then it would be great if the roof didn't need a lot of work. Sometimes we have to replace the entire roof. Sometimes it's sections. Sometimes it's just a few patches. We
Mhm.
can get lucky. Ceiling height inside, we need at least 12 to 14 feet, but most of these buildings are taller than that. 18
Mhm.
feet, 16 feet, doesn't really matter, because we're going to go in and put in all new LED lighting. And it's going to typically all we do is climate control. So
Mhm.
we put wire mesh over the top of the storage units, and then the air conditioning just blows everywhere, or the heat. And that keeps everything, keeps the humidity down, keeps the temperature within a certain range. It's not office space. It's not going to be, 68 degrees year round,
Yeah.
but you want to keep the humidity down, and you want to keep the temperature range, in the summer, you want to keep it at high 70s. In the winter, you want to keep it in the low 60s. And,
Yeah.
if it's 40 degrees outside and you come in at 60, 62 or 64, it feels
Wow.
great. It feels
Yeah,
great.
that's true.
Yeah. And same with the
Yeah.
summer. So yeah, those are some of the things we look at. And then, of course, the buildings we like to buy are typically retail. We bought a grocery store. We've bought Kmart buildings, factories. We like good traffic count, because
Mhm.
people use storage when they see it and they drive by it all the time. So that's why we like the conversions and the big box retail conversions, because Kmart put their location there for a reason. And a grocery store went there for a reason at some point, because there's a lot of people live there
Traffic
and
around
and
there.
drive
Yeah.
by. Yeah, high traffic counts. So our typical, locations have traffic counts of 14,000 cars a day, 18, 20, 24,000 cars a day, in one
Mhm.
in Georgia. And So our focus is on the 5 states around us: North Carolina, South Carolina, Tennessee, Georgia, and Virginia. So those are the kind of the area that we're focused on right now. But we're certainly happy to look at anything further out if it makes sense.
And what's your main source to find these deals?
So we have a network of brokers that self-storage brokers that know that's kind of what we like. We've had off-market deals brought to us by brokers before, which is fantastic. Or we do our own research. We have somebody that's in charge of acquisitions. Drake is our acquisitions director, and he's on CoStar all the time. We pay for CoStar, which is expensive, but we feel like it's a tool that we have to have. So it's a super robust, commercial real estate. Obviously, your listeners know all about it, but he spends a lot of time on CoStar searching different towns and cities and looking at vacant buildings. And then he has a whole underwriting spreadsheet that we feed it into, and then we just start filling it out, like how much competition is there. And he keeps track of all that in the spreadsheet. There's 5 locations that are within an 8-mile radius. Here's the rates they're charging. Here's their occupancy, and we think, once that box is checked, then we go to the next one until we're ready to submit an LOI, letter of intent. And then once we get a letter of intent accepted, then we'll move towards a purchase and sales agreement. And then we'll make a site visit, and we bring our construction guys. We bring as many subcontractors as can make it. We usually schedule 2 or 3 days on site and really dive deep into the whole building, the whole neighborhood, the project. We call it, we get the feels. So we just drive around and see what's going on in the neighborhood and see, what kind of trajectory. If it's an abandoned building, maybe it's not in a great part of town, but there's also a lot of areas that are getting, gentrified, and we'll drive around and see a great little brewery or, a cool coffee shop or whatever. And like, okay, I can see, or we look for builders that are renovating old houses and really, doing a lot of upfits. And then we're like, okay, we can see that the trend is in the right direction here. This feels like we could do well here. And as this neighborhood starts growing, maybe there's a multifamily project underway. That's always great for storage.
Yeah.
And then of course we pick apart the building, go on the roof, go look at everything, and really kind of hone in our construction budget during that visit, during our due diligence.
Awesome. And what about the value adds that you do normally?
So for us, most of the stuff that we do is what we call heavy value add. To me, value add is if you're buying an existing storage, and maybe they haven't been. Oh, go ahead.
I was referring to, of course, when you're doing a new one, right? It's all done. There's nothing value add that needs to be done.
Right,
it's
right,
all
yes.
So normally, if you buy an old one, right?
Yep.
Then how do you try to do a value add to bring up the rates?
Right. On an old
Existing
storage.
Yeah.
Yeah. So it's thin. I mean, it can be thin. Like maybe the rental rates need to come up, but not a lot. And maybe expenses need to come down, but not a lot. So you definitely can create some value there. But what we like is actually changing the asset class from retail to self-storage. And, our typical construction project is 2 to 4 million. So we're adding a lot of investment into this building by changing it from one asset class to another. And that's what we call heavy value add, to where you're actually, doing some heavy lifting, and we wind up with some pretty incredible margins. So,
normally, what is your cost per square feet for these conversion, including the land, like everything?
So it's a little bit all over. We've bought buildings as cheap as $10-11 a square foot, or maybe 80,000 square feet for 1.5 million. We've paid as much as $20 to $25 to $30 a square foot, depending on, again, the age, the location. Like we could pay more for the building if it's got a brand new roof and it's already got sprinklers, it's super clean. So anywhere in that range, let's say $18 a foot is what we pay for the building in the average there. And then we will put in another $35 to $40 a square foot for the construction part. So we're all in for, let's call it $55, $60 a square foot. And then as we lease it up and, manage it, depending on depending on the market, but self-storage can sell from anywhere from 120 to 150, $170 a square foot. So we're at least doubling what we're putting into these projects. What we may be all in for 5 to 6 million, and the appraisal, the feasibility studies all say, once it's converted to storage, it's going to be worth 9 to 10 million. And then as it's leased up and stabilized, it's into 13, 14, 15 million. So that's a lot of equity that we just created that we can we still don't have a lot of stress on the asset. The debt to the loan to value is quite low. So the plan is, our business plan is refinance after 5 or 6 years. Once the property stabilized, interest rates are where we want to see them. Then we can refinance, pay back the investors, catch them up on preferred return, catch them up on, pay back return on their capital, of course, return of their capital. But instead of them being out of the deal, then we leave them in the deal and we all get to continue on with the cash flow. And if it's a refinance, that's equity that we've taken out and paid back to investors, but it's not income because it's just more debt on the property. But the property can handle it because rental rates have increased along with inflation and all those metrics. And so everybody's whole without paying tax, and they've gotten return of their money. And now we go on and keep going with cash flow for another 5 years, 10 years. Who knows?
That's great. Yeah.
I mean, most of our model.
That's what I love about real estate, right?
Yeah.
You can refinance it and there's no tax on the debt.
No,
right?
no,
So
it's not income, it's just more debt.
Yeah.
Yeah. So I'm sure Tom Wheelwright. He wrote Tax-Free Wealth, and he's got, his phrase is buy, borrow, and die. I don't know if he came up with that, but you buy the asset, you just keep borrowing against it. You're never going to stress the asset out, right? You always want to keep your loan to value. I mean, I like, 50 to 60%, I think is enough stress. But then as the value goes up, now your loan to value is 40%, where you can take another 15% there, and the property is still going to perform. So just rinse and repeat.
Rinse and repeat. Absolutely. Yeah. Normally, what is your equity and debt? Tell us something about your equity as well as debt structure on these projects.
So we are the way we're structured right now, and we're raising capital for a fund. We have a 506c fund going right now. It's called El Fundo, and it's going to be probably for 5 self-storage assets. We've already got 2 in the fund. And we've been 506B, but we just recently converted to 506C, so I'm allowed to talk about it. This is our first 506C offering. So everything else we've done up till now has been just one syndication per property. So we're really excited about this fund, and we think it will probably buy 4, maybe 5 properties. And as I said, we already have 2 in it, and then we've got one that we're probably going to submit an offer on next week. But this is going to be a $10 million fund. And that will be equity that we'll put on probably $40 million worth of real estate, let's say. And then when we build out and stabilize that, it should easily be in the 75 to 80 million range. So there'll be a lot of equity there for everybody that's in the fund. And so we will, it's going to be fun to watch how it works in a fund. We can refinance one property and catch up everybody's preferred return, or maybe we sell one if there's a great offer on the table, and we can keep the last 4, right, for everyone to share in the cash flow for that. So as far as an individual debt structure goes, we typically are using regional banks, community banks, credit unions, some larger banks, but we will get 70% loan to value, 65% loan to cost. And then we'll raise the equity for the portion of it. We do put cash into our deals. We are usually fronting all of the soft costs up front, feasibility study, environmental studies, engineering, architecture. That's all risk that we're taking before we even close the property. That could be anywhere from $50,000 to $100,000 per property. So we have to, obviously we want to feel good before we start risking our money. And before we ask investors to risk their money. And then typically we're personally guaranteeing the debt as well. None of the ground up construction ones that we have right now are non-recourse. They're all recourse debt. So that's a commitment we're making to our investors. Like, we believe in these. Obviously, I'm putting my name on the dotted line, and so we know this is going to work, and we feel very confidently that we can get it converted at this price, get it leased up, manage it, and do well by our investors. So the phrase that we use around here is we want to protect the asset first, investors second, and then we come in last. So obviously, if investors get paid before we do, and but we also kind of want to protect the asset, because it's the vehicle that's going to pay us all, right? So if there's an issue with a decision that needs to be made, we don't want to over leverage the asset. We don't want to stress it out. We don't want to kill the golden goose, right?
Yeah, absolutely.
Yeah.
Yeah.
So asset first, then investors, and then we're last. But we feel like if we do our job right, there will be plenty for us at the end.
And while you're doing the conversion, right, how much does bank loan, right? For example, to buy the empty building, how much does bank lend you?
It depends.
40%, 60%.
Yeah.
And
So
then,
typically, good question. We'll go to the bank with our whole business plan. We'll say, here's a building for, let's say, 2 million. Here's a building for 2 million, and we're going to put 3 million into it to convert to storage. So the whole project is, and then we want interest reserve, and all the fees to get the thing. So maybe it's 5.5 million is the total project. So then we'll bring that to the bank and say, the building is 2 million, and all the other costs I just mentioned are, the total project is 5.5 million. And they'll typically loan, say, 70% of that. So 30% of 5.5 is 1.8 million ish. So that's what we need to bring. So we'll come to the closing with investors' capital and our capital, and 1.8 million but the building is 2 million. So then the bank puts in 200,000 to close, right? And then we own the building, and we put our money in it in the front, and then the rest is held in the account. And then as we do the construction, our construction company, Elm Builders, is building for Nomad Capital. And so then Elm Builders draw requests from the bank. And then as we get draws, as we do the renovations, might take 8, 10 months, 12 months, depending on how complicated it is. And then as soon as it's done, then the interest reserve goes back to the entity, City Storage, whatever. And then we're leasing up, and City Storage is our management company. So we have the interest reserve in the account to carry us through until we're cash flow positive. So that's kind of a...
So this is kind of a construction loan, right? It's interest only construction loan.
Correct.
And once you are done with the project, it gets refinanced. The whole project gets refinanced. Is that right?
Yes. Well, it depends. So usually, I guess, most of our loans are 5-year loans, or 7 or 10. And depending, we were getting 36 months of interest only because it was a construction project. But now we're seeing a lot of 24-month interest only period. So that will get us, from the day we close, that will get us 12 months of building, let's say. We're still interest only on what we've drawn. So it's not the full amount until we're done with the construction. Then the heavy part of the interest, interest only is going while we're leasing up. And then by the time it converts to principal and interest, we're stabilized enough to where the property can carry the debt. And it starts building up, distributions for investors. So investors' money has been working with the preferred return since the day we closed, right? So 2 years, a year and a half ago, a 6% or an 8% pref has been accumulating. So as soon as the property starts stabilizing and seeing cash flow, we're going to start catching up that pref. All the money goes to the investors until that pref is caught up. And then once we get over those waterfalls, then it starts coming to the general partner, which is us. But then, maybe it's year 3 or 4 by now, but by year 5, we're going to refinance anyways, take out just enough cash to get all of the investors' pref caught up, if we haven't caught it up already, and return of their capital. And then we go on from there.
And what is the normal split between the investors as well as the general partners?
It varies. So it varies on what the equity is per deal. So typically, like it's an adjusting thing is in El Fundo as well. But everybody that's an investor is actually, a limited partner on the LLC. They have an equity ownership depending on how much they put. All the investors together typically it's probably 40 to 50% of the project. And depends, we'll see how it works at the end of the fund, but it will be somewhere in that range. And the multiple that we're shooting for is we're trying to give people a 2x multiple after 5 years. So essentially double their money, which working backwards is about an 18 to 22% IRR on their cash over the first 5 years. And then once we refinance and pay it all back, then of course it's infinite returns. They've got all their money out and it just continues on. And maybe after year 10, we refinance again and you get another bump of tax-free cash and you still get cash flow, or maybe we sell it at that point, or, who knows what. Most of the things we have, we're targeting to sell, but if everybody's making money and it's free money, why not,
Yeah, that's true. Absolutely.
Yeah.
Hey, Erik, I'm loving this conversation, but I just wanted to be respectful of your time. Yeah, so we'll switch on to the final round of questions. But before we go there, is there anything that you want to tell to our listeners about your business?
Yeah. So obviously it's called Nomad Capital because we were able to travel internationally for, I think we were out of the US for 5 years altogether with a big family, which is hard to do these days, but really attribute that to passive income from real estate. So that's why we started Nomad Capital. We want other people to be able to live, on their life on their own terms, with independence of time, location, money, and then and that will give them freedom of purpose, right? So
Absolutely.
that's really what we're passionate about, is creating nomads, whatever that looks like. You don't have to go take your family, you don't have to go drag your family on a sailboat if you don't want to, but I'm sure there's dreams that everybody has that it's like, if I could just get out of this 9 to 5, if I can get out of this cubicle, I could go live life the way I want. I've always wanted to do this thing, I've always wanted to, whatever it is. It doesn't have to be, out there. I want to go see I want to drive to all 50 states in an RV, or I want to take my grandkids to Peru, or whatever it is. So we want to help people get there. That's why we really like this idea of strong cash flow for long term.
Yep. And it's all about freedom of time, right? In whatever you want to do.
Absolutely.
Whatever you love.
That's the thing you can't replace. I mean, money comes and goes, and possessions come and go, but time, that's it. You get one shot.
And that's what we focus on, decoding cash flow. The cash flow gives you that freedom of time.
I love it. I love it.
And all right, ready for the final round of questions, Erik?
Sure, let's do it.
Okay. All right. Which is the one book that you'll recommend which had the most impact on your life or on your business?
Well, let's see. I'll have to pick two. And one's kind of a cliche. It's not a real estate book, but Rich Dad, Poor Dad really helped me think differently about money when I first started my business in the early 2000s, and just really breaking down the investor versus the self-employed versus the, employee, and all those kind of thoughts. If people are familiar with that, that was a big shift. Just really kind of bigger picture of how to look at a balance sheet or a P&L, a profit and loss statement, just how that should flow into everybody, whether you're self-employed or not, you have a P&L and you have a balance sheet. That's just the way it is.
That's true. Yeah.
It's just, if you know how to read them or know what they mean. So that was a huge book for me. The second one I'd have to say is Millionaire Real Estate Investor, Gary Keller from Keller Williams. It's a fantastic book, and it's just it just talks about building a network. And it's really cool to see, like, I read that book a long time ago and then just kind of forgot about it, but I've recently looked at it again. I'm like, I've been doing all these steps. It must've been subliminal from when I read it, but having an attorney that's in your corner, a broker that's in your corner, an accountant, a CPA, and just this team of people. I mean, I talk to all these people multiple times a week, and that's really your team, whether they're on your payroll or not. they're just associates that are helping you get to where you want to go. So obviously everybody's somewhere along in that journey, and that's a fantastic book. I really love the case studies at the end, if you remember those, but it's a great book.
Yeah, it's a great read. It's a great read. It's an extract of all the interviews, like, hundreds of millionaires, how, you know, how they accelerated their career in real
Right.
estate. It squeezes everything into one book.
It really
So
does.
yeah,
It's a great book. So I'd have to
yeah,
say, if you haven't read that one, you need to pick it up.
yeah. Okay. So the next question is, what is your main source of information to learn and grow?
I soak up a lot of information. I guess I should say a lot of noise, and then you have to decipher what's worth keeping, right?
Yeah.
It seems like Twitter seems to be a pretty good spot for real estate guys, kind of where Bigger Pockets was maybe 10 years ago. Um, so Twitter seems to be pretty cutting edge. I like to follow a few folks on there, storage guys, real estate guys. Um, I follow, what else do I follow pretty regularly? Podcasts, of course, fantastic information out there. Um, so podcasts for sure. And then I think the third would probably be audiobooks. I always usually have an audiobook going, whether it's real estate or just inspirational or what have you. So that's kind of how I soak up information. I guess I'll add a fourth, and that would be networking. So we host a monthly commercial real estate meetup here in North Carolina, Wilmington. If anybody wants to swing by, would love to have you. And I've just been involved in other conferences are great that really change your mind on forward thinking. We've been going to Best Ever conference for several years, Joe Fairless,
Me
and
too.
that's where we
Yeah.
really clicked with syndicating, and went there a few years before we decided to start syndicating, and it was game changer. So
You're going to Utah this year too?
yeah, we're going. Yeah, we're gonna have we're sponsoring. We're gonna have a booth there. So
Awesome. I'll see you there then.
swing by. Yeah, we'll
Yeah.
have some merch.
Sure. Awesome. And what is the best business or investment advice you like to give to our listeners?
I would say that it's not a sprint, it's a marathon. I think there's a lot of noise out there that tells you get rich quick. This
Yeah.
is do X, Y, and Z, do a side hustle, you'll be a millionaire in a few months. And it's just, I think it sets people up for discouragement.
Yeah.
It's certainly not overnight, but it does work.
Mhm.
I think if you could look at it as a marathon, it's the most reliable marathon that you can run. Like, as far as if you just pick some niche in real estate and stick with it
Mhm.
10 years, and it will change your life 100%.
Yeah.
So, I mean, I don't know any other business or industry like that where you just go and it won't be 12 months, won't be 18 months, but you'll start to see some results in 4 or 5 years, and that will
Yeah.
just give you more momentum to keep going. And then, like I said, by 8, 10 years, you look back and you'll be pretty blown away, and wonder why you didn't start sooner.
Absolutely. I also say to all my listeners, all the time, it's not a get rich quick game.
Now,
It's a hustle. It takes a time to get the ball rolling, but
yep.
once it starts rolling, yeah, you'll see the results very quick.
Yeah. Yeah.
Yeah.
I mean, you will have some incredible highs and lows in
Yeah.
that. You'll get a deal that you got under contract that you can't believe, or
Mhm.
you'll sell something for double what you thought it was worth, and somebody will bring you an offer that you can't believe, and it's like, well, yeah, those are get rich quick, moments, I suppose, but it's all happening while you're on the grind.
Yeah.
So
And 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 people don't notice how much effort went into that particular
right.
deal. Yeah.
Yeah, you
Yeah.
could do that with anything. You could look at
Yeah.
stocks, right? And you'll be like,
Yeah.
if I would have just bought this stock at this point and sold it at this point, and then, I mean, you could do that
Yeah.
with everything. So I think people see that in real estate. They're like, I
Yeah.
bought this apartment building for 10 million and I flipped it in, 15 months for 25 million. It's like, that's not the norm, but
Yeah.
um, it's
Yeah.
also the hindsight is 2020, right?
Yeah. All right. Final question, Eric. how can Decoding Cash Flow listeners get in touch with you?
Yeah, I'd love to chat with anybody about what we do at Nomad Capital. That'd be fantastic. So the easiest way is our website, nomadcapital.us, or feel free to reach out to me on my cell phone, 910-431-3855. Love to chat with people and tell them what we do. And if I can help them out in any way along their journey, be fantastic.
Awesome. All right. Thanks a lot, Erik. It is a pleasure having you on the show.
Thank you.
We'll stay in touch.
All right. Sounds great. Thanks. Thanks so much for having me on, and have a great weekend.
You too. Thanks. Bye.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.